Gets into government intervention, I guess, in exchange markets. We got to see how the government's role with this, because really chapter 20 focuses more on market exchanges, right, where we talked about how exchange rates move, what causes them to change. I mean, there was a little bit of talk of government when we brought in stuff like money supply, but we'll talk a little bit more details here in this chapter. Our final chapter. So I'm going to start off with some international accounting. How we keep track of the books. So, in general, each country keeps track of payments to and from other countries. So most transactions are being handled through bank accounts, so we can reasonably keep track of this. You know, briefcase deals with currency going in duffel bags across nations obviously is under the radar, and so we do have a way of accounting for that. I don't think it's real maybe acceptable from an accountant's perspective, because it's kind of like, oh, what's ever left over must have been under the table. It's kind of the approach that we'll show where that plays into, that comes into account. But for the most part, the lion's share of transactions are able to be kept track of. So we have 3 balance of payment accounts. 3 balance of payment accounts. And the first one is the current account. And the current account keeps track of the value of exports What are exports again for the United States? Shipped out. So stuff we've sold to foreigners, right? So the value, the dollar value of those exports, so we're talking in money terms here, the value of exports minus the value of what we purchased from them, imports. If you remember way back to macro, well, we even talked about it in money and banking for that matter. We had our old cigarettes. Consumption plus investment plus government spending plus net exports. That's this part of the equation. So in a little more formal terms, this is drawn from the current account. So it's also referred, in this context here, it's referred to as the trade balance. So simply, what are our exports minus our imports? But it's a subpart of the current account. So the current account also adds in net interest paid. And what this is what we paid foreigners, what we paid the rest of the world, minus what they paid us. What sort of interest payments? Where does the interest come from? Financial security, stuff that we, and so that's going to come in a little bit later here, but I want to make that distinction is that here we're talking about the income. So this is really foreign, this is can be thought of as investment income. This is the income that was generated off those underlying assets. So maybe the easiest one is to think of as bonds. So when the US government pays a coupon payment to China because China's holding the bond, we have an outflow of money out of the United States, right? So that's interest that we paid the rest of the world. And on the flip side, we have interest payments coming the other direction. If we're holding on to a German bond, then they're paying us inflow. The United States has a flow coming from Germany off that. So that's the net interest paid. And then finally, we've got net transfers. What we give the rest of the world free of charge. So international support going to Ethiopia or some other causes. The money we give Roe minus what they give us. As you can imagine, there's not a lot of flow. There's a little bit that comes to the United States from foreigners. And so this one ends up being us having a positive number. But we're subtracting this off of the total, and that gives us our first balance account. This minus this minus this minus this gives us the current account balance. Okay, questions on that one? All right, number 2. Also very important, the capital account. The capital account keeps track of foreign investment in the U.S. minus U.S. investment in the rest of the world. How does this contrast with this one that we just did? What's going on here with that versus net interest paid? Okay, and specifically invested how? Somebody else want to jump in? I'm okay with that. I'd like to just add on to it. What are we doing here? This flow of money that's different from here.
The actual purchase of the security versus the
Okay, good. Yeah, so if we have the bond, if we have the T-bill that is a $1 million face value with a $100,000 coupon payment. When we purchased this, it was purchased at a discount, let's just say. So this was a 5-year bond, and we were 2 years into the 5-year bond, so there was 3 years left. And remember how the current market interest rates then are going to dictate what the current value of that bond is. So when somebody goes and purchases this bond and it deals with a foreigner, we're in this world. So the $900,000 that was paid for this $1 million bond, that purchase gets kept track of here because it's the underlying principal rather than the interest payment that was flowing off of it. Okay, questions there? So these are so if we want to look at U.S., it doesn't really matter, but these are, I guess for both of them, let's just note here, these are the actual purchases of financial securities. Those play the large part of it, so bonds, stocks, bank loans if we're talking those sorts of purchases.
So, as we're talking about this, we're calling them funds, but you're wanting to just, are we talking about, like in a period of time, the purchases of
Yes.
financial securities? This isn't a fund necessarily.
It's the flow of that over a period of time. So like over the course of the year in 2015, what was the amount of foreign investment in the United States? How many Chinese, what was the purchases of Chinese bonds versus vice versa, what we bought from other countries? So the actual purchases. Good?
Yeah, so we would be clearing this out
Yes.
in theory.
Yeah, it's just going to be netting out, right? So it's like on the income statement, we're looking at the flows over the course of a year. And of course, you know, bringing that back into the change of the balance sheet. If we can think about the balance payment, so the language is a little confusing. Even like, this isn't balance sheet. This is the balance of payments. So it's the track of flows over a period of time. And then if the Chinese already own $60 billion worth of notes and they purchased $3 billion more, then they'll have $63 billion at the end of the time period. Okay, then we throw in our statistical discrepancy here. So plus statistical discrepancy. And for the most part, this is relatively small, so it doesn't give a lot of headache. It's not like this is 200 and this is 300 and this is 1400 or something. You know, it doesn't swamp. It's actually a very small fraction of it. And so we add up these three things, and we get the capital account balance. And so statistical discrepancy picks up illegal, so black market type transactions. Probably can pick up little whoopsies of accounting errors that didn't quite match. All right, so our final account is the one that this chapter really spends some time on, and that is the official settlements account. The official settlements account. I think that's how your textbook here worded it. Let me double check. All right, so this is the government holdings. So this is foreign government holdings of U.S. currency. Foreign government holdings of U.S. currency minus U.S. government holdings of row currency. And I'm kind of squeezing down at the bottom, but this is the official settlements balance. Official settlements balance. So around the world, different governments are holding within their vaults, kind of similar to the way the Federal Reserve holds different types of currencies in its accounts as part of its assets and liabilities. And so that's the other player here. All right, so in an accounting fashion of debits equal credits, if we keep track of all these flows and we got the statistical discrepancy to pick up the garbage, we've got this one plus this one plus this one all equals 0. So that's our accounting part of this. So note the three balances sum to 0. So in the United States, what's true of the current account balance? It's negative. Yeah, it's been negative for a long, long time. And now that we know that the three got to sum to 0, if this one is close to a push, let's call it, or relatively small, then what's going on to fill the picture of telling the story here of we got, for the most part, it's these two again, you know, exports minus imports. That's what drives this negative balance. These play a role, but they're relatively small. And how does that fit in here?
Foreigners are using the trade surplus that they have in the United States to invest back into the United States.
Okay.
And there's a lot of black market things.
No, not so much black market. Yeah. Okay. So.
What are the options?
Right. This is relatively insignificant here. So. So who is borrowing? Who is the borrower? The U.S., right? So the kind of, to bring this down to a little more micro level from this abstract macro, we are buying more stuff than what we're selling, which means we owe them money. Because if it was just a one-for-one trade, it would just be a fair deal. I'll trade you this wonderful free market cure for your glass of water, and we're done. But if all of a sudden we're taking, well, I'm going to get your glass of water and I'm going to get these marker bags, but it's like, hey, you got to make up the difference somehow. How are you going to do this, right? So we owe the rest of the world some money. And from a fundamental standpoint, I don't know why this thing goes goofy. It seems like it's just this classroom that does that once in a while. Huh. Well, I'm not really planning to use it anyway. Let's see if we just shut her down. Okay. So from a fundamental standpoint, they don't really kind of give us an explicit loan, right? But they're choosing in a free market sense to buy our bonds, our IOUs. So that might come across in terms of corporate bonds, government bonds, and so it's like they're lending us money, but it's not really explicit is kind of the point I want to make, is that it's really a market transaction of they're choosing to bring that money over. If not, then there'd be some other things going on, which is kind of interesting to think about. I'm not sure I've even taken this particular lecture that direction before. So if they didn't like U.S. in terms of lending them money, what would be the other mechanism that would make up this issue here? And I just want to kind of think about, suppose they thought that the U.S. was going broke, and so they didn't want it. They're like, that's crazy, I'm not going to lend that Obama any more money. And they started to dry that up. You know, what other things would go on to close this gap?
When we start, your body language is covering up my answer, which means I shouldn't answer it. But I was thinking when we stop importing so many goods and try to become more self-sustainable.
Yeah, not necessarily in an attempt to become more self-sustaining, but I think this would be one place where we would make it up. So what would be the mechanism that would lead towards Michael's comment. This is one spot. I think there's some other spots too, but yeah, this would be one spot where we could make it up. What would happen? Okay, imports would become more expensive, right? And so as their price starts to go up, we start importing less, right? Starting to close the trade deficit. And so that would be kind of the market mechanism that would start to fill this up if they didn't trust the American government to make up the difference. They would stop loaning us money, which would cause another price to start to change. Good. Did I see another hand up?
I had one. I was originally going to ask, with the surplus of U.S. dollars that would be going to the foreign countries, would that not kind of affect the official settlements account with that $9?
Right. So. Not necessarily. So if we kind of go back to ceteris paribus, if the government doesn't intervene, then the mechanism that would start to change here to make imports relatively more expensive would be the exchange rate would start to make it effectively more expensive, right? And then on top of that, there might be some internal things going with the actual underlying fundamental price too. But either way, that might start to change. But certainly that's another possibility. As there starts to be a distaste, maybe the foreign governments would start to intervene and start changing their balances. So that might be another place where the gap might start to close. Okay, so important takeaway here is to thing most of you know from multiple classes. The U.S. is a net borrower. A net borrower. Because of the current account deficit. We buy more than we export, and that forces us to borrow. Rho being willing to lend via purchases of bonds, purchases of government and corporate bonds, mostly government bonds, but so I'm kind of using this lending language a little loosely. So Rho being willing to lend has kept interest rates low for American consumption of imports. So questions there before we move on?
So what really is like an indicator to another country that they're taking on too much risk? Well,
Good question. And a tough question. So what's an indicator, let me make sure I understand, what's an indicator to another country who's considering, like in this case, a U.S. government bond, of whether there's too much risk or not? Let me throw that out to you guys. What are some indicators, and this one you can kind of go back to micro a little bit on and think of, what would be an indicator that I might start to be getting a little cautious to buy that GM bond or some other corporate bond, because it's kind of similar, right? We can kind of think back. What would cause you to be cautious about whether I should continue to be willing to lend money?
Your interest payments are becoming increasingly closer to what your output is.
Okay, good. That'd be one thing to look at. So interest payments as a fraction of your overall payments of whatever your, in a business context, whatever your other payments are. In the government context, we'd have weapons of mass destruction, national defense, all the ongoing infrastructure. And in the United States case, we have this large fraction going to Social Security, Medicare, et cetera, et cetera, et cetera. Okay, good. What else? So interest payments as a fraction of that, I think, would be one thing to look at. You start to get a little scared when we're paying out more in interest than we're spending on national defense. Then we start to say,
That was actually compared to GDP, but
or GDP, yeah. What else would cause you to not want to loan, or at least make it cautious, make you look twice, besides the interest payments on buying a GM bond?
Well, if we're talking about country to country, looking at the value of the currency as well. I mean, if the currency's decreasing in value over a point in time, it's going to be less likely.
Okay, the exchange rate risk associated with it?
Well, just how that would also show on how the country's doing as a whole.
Okay.
No.
I'm just, yes, I mean, but I don't think that would be a huge role, but yeah, that'd be part of it, because what's tied in the long run, what did we learn from purchasing power parity, long run connection between the exchange rates and the country? What was it? The price levels, right? So we had the real exchange rate and the purchasing power parity kind of showing us the relative price levels influencing the long run exchange rate. So in that context, definitely related to it. We're missing one big item that I think would make us a little cautious on whether we continue to fund that particular country. Or we can think about it in the case of GM. It was related to interest, but interest is one thing. Interest payments would be high if what's high? Risk, yes, potentially, but the debt would drive the actual underlying payment, right? So one of the common things that we use to monitor countries, I've seen a lot of index, certainly the Economic Freedom Index that Courtney uses has this, and some other just ways that you present country comparisons, is what is the fraction of debt to their GDP? Where's the United States on that one? Yeah, yeah, if not even a little bit over. Yeah, so we're right now, depending on how you're calculating debt, by the way. So if you're looking at net debt versus total debt officially, so the national debt numbers are getting towards like $18 trillion, which is almost a one-to-one type of basis with our GDP, nominal GDP. Again, depending on what measures of GDP and stuff you're using. So that is definitely one metric that is used. There was a presentation at this conference on this too, and I kind of came in late to it, so I saw this guy's slides, but he had all the countries listed there, top 5, bottom 5. Some of the bottom 5 countries are at the like 200% level. So if they have $10 trillion worth of GDP, they have $20 trillion worth of debt. And so that's when you start to get into Greece and you start wondering, how much more debt can these people take on? You know, and then again, that'll tie into the interest payments. So the interest payments might be more closer related to the current market rates of interest, because that, if we're at really historically low interest rates, i.e. right now, and we double the interest rate, then our interest payments are going to be real sensitive to that. Even if our debt remains constant, right? So let's say we promise we're not going to do any more debt. That's our austerity measures that the IMF kind of puts down the pipeline to us. We're going to keep it at 20 million. Well, the interest payments, though, are still going to fluctuate. Even if you've committed to not taking on more debt, your interest payments are still going to fluctuate according to market rates. If you're continually rolling out, 5-year bonds or whatever, then you're still subject to interest rate fluctuations and exchange rate fluctuations. Okay. Anything else there? So let's take a look at the effects of the government changing around their holdings, their balance sheet. So intervention, let's call it government intervention. It's really central bank intervention, but as you guys know, in some countries, the central bank and the government are one and the same. It's not set up like the United States where we have independence between the central bank and the government. So it's okay in general to say or maybe more appropriate to say government intervention, regardless of how the country is run and how independent the Fed is. So intervention in the foreign exchange market. All right, so I'm not very good at T accounts, so you accountants can laugh at me here. So I'm going to try to do the Fed's simple balance sheet. I even got my cheat sheet in front of me, and I'm not feeling totally comfortable here. So we got assets and liabilities. Now this is the central bank, the Fed. What is our liabilities for the Fed? What's on the liability side from previous chapters we've looked at, and money and banking for that matter? Currency and circulation, good. So we got basically currency and circulation, all those little notes. The Fed is technically liable for. Now we've talked about this before. If I go to Janet and I say, Janet, I learned in class, you've got yourself a liability here, and I'm here to say, I want my share. There you go, take it. What does she give me back? 5 ones, you know, she'd be like, hey Russell, what would you like? Would you like that? And 5 ones or a 5 right back, right? So the obligation of the Fed is to return to you this. That's all we got. There's nothing backing the currency, as we've learned. So that's important to remember. As long as we're doing this, what else does the Fed have on its balance sheet? Even though it's less applicable in this context. So currency in circulation. How does the banking system work again? Some deposits at the Fed by the banks, right? So they are the banker's bank. So we got the required reserve deposits. Okay, so that was just a little bonus thing, just to kind of remember that that's the liability side. This really ends up setting up the monetary base for the United States, which is talked about in this chapter quite a bit. All right, so on the asset side, if the bank has foreign assets, so this would be foreign currency. That's one of the assets that they can have. And so we want to think about a transaction of them intervening in the foreign exchange market. So if they take out 100 billion, let's make a nice big number here, 100 billion what happens? How does that flow through? Now, careful with taking out. So if we're subtracting the asset, are they selling or buying more currency? Let's just kind of think about this as euros. So if they are reducing their asset,
They get a different answer.
they get a different asset, right? So they are actually liquidating that asset. So we're going to be dumping it on the world. And what are they going to get in return? What's going to come home to them?
More currency.
More currency, right? So assets liabilities concept here, we got the plus 100 billion coming back to the Fed, which from a monetary perspective did what to the money supply? Money supply went down, right? So when we have more money coming into the system, our money supply is going to be falling. So there's a decrease in the money supply. And what happens with a decrease in the money supply to interest rates? I have a plus here. This is actually a minus, isn't it? What happens to interest rates? They go up. So we might reflect back on our little market system here with money supply, money demand, money and banking, 101 here, interest rates, money supply decreases, interest rates ramp up. We're going to put the little superscript D on it. Why? Domestic interest rates, because we're kind of put this foreign spin on it here. So United States interest rates rise relative to the rest of the world, causing what to happen with exchange rates? Appreciation or depreciation? What I hear? Kate? Appreciation. Everybody agree? Right? So our financial assets look more attractive relative to the rest of the world. We have an inflow of dollars. The demand for dollars increases, and that leads to dollar appreciation. Okay, so what if the Fed does not want to have an effect on exchange rates? That really wasn't the intent of it, to have an influence here. What if the Fed didn't want this effect? They did want to dump their euros, so they wanted to do that, but they didn't want it to really impact dollar appreciation. That wasn't the purpose of it. They were just kind of rearranging the balance sheet.
So would they have to market sale?
Okay, so if they do an open market operation, would it be a sale or a purchase that they need?
In this case, it's
Sale?
oh no.
Purchase?
Yeah.
So remember, I like to kind of come back to I'm the Fed, I'm Janet Yellen, and you guys are the marketplace. So if I do an open market sale of a bond, then I bring the bond to the market and I take out money, right? Open market sale would be a decrease in the money supply. So if instead I do an open market purchase, the bond's being traded, I come out, I'm Janet Yellen, and I give money, I take the bond out of circulation, money supply has gone up. What has happened to the Fed's balance sheet?
Basically changing one balance or asset.
Right, and so yeah, what asset went up? Government bonds. So now instead of holding foreign currency of 100 billion, if I go offset that and I increase my government bond holdings, and this would be, U.S. government bond, it really wouldn't necessarily matter, but U.S. government bond holdings, I have effectively sterilized the initial change. So, note, if Fed buys government bond, it can sterilize, this is the real word we use, it can sterilize the effect of the sale of foreign assets. So the open market purchase leads to an increase in the money supply, which all by itself, ceteris paribus, would lead to a decrease in the interest rate. And let me put a little extra parentheses, offsetting the one we did up here, because we're doing these in tandem now, or we're thinking about them in tandem, causing dollar depreciation. But again, in this case, it's offsetting what we did before. So this effect here is an unsterilized intervention. And by making this offsetting move, we've sterilized the effect in the foreign market, the foreign exchange market, but we have effectively rearranged the Fed's balance sheet. Okay, so let's do a quick little graph of this to kind of keep that in. Graphically, still got the same setup we did from chapter 20. So we're looking at the quantity of dollar assets, which was essentially all the money supply, being vertical. And we're going to allow changes in the exchange rate being completely driven by shifts of demand. We got this exchange rate, which is foreign currency divided by dollar is the context. So the shifter from chapter 20 is this one, right? So the short run effect of spiking up the interest rates leading to dollar depreciation would be the demand curve shifting to D2. So if you want to just tie it back to this graph, D1 to D2. And then we can offset that by sterilizing. This is D2, kind of undoing it back to D1. Of course, in theory, if they're doing it simultaneously, it just never moves. So note if done simultaneously, which is what they would do, by the way. Demand never shifts. We kind of show it in this chunky version, but it's really not going to do that. All right, call it a day there.
Question.
Yep.
So this is Sunday night, right?
Like I said, I got so many due dates. I think I changed it to Monday because it was the last day.
Okay.
Obviously, you're welcome to do it early.
Papers do Sunday night, this is due Monday.
Yeah. Well, my question was, by Monday, you need to be able to drop another one of those sheets to see where we sit before I'm out.
Or send it out.
I will try. Yes. And
If I was Wednesday at 1 in here,
I might not do it. I might do it ahead of time rather than. Is that what you were asking? Or-
Yeah, that's why I was wondering if it, like the
Just
do
one,
Sunday
basically,
night.
sometime between now and
Yeah.
later.
That'd be awesome.
Like, if